My suspicion is that I was competing in a market with speculators whose methodology was got a hunch, bet a bunch. And those people always get wiped out when you have these precipitous share price declines. I didn't know if what you discussed would happen at the end of January or the end of February or the end of March. But I do know that in sort of 95% of the time that I've experienced things, when you have a parabolic chart, when you have as the Canadians call it, a hockey stick chart, that the market gets overextended and it collapses. That's just what happens. The backside of a parabolic chart is just as steep as the upside, but it's a lot less fun if you happen to be long. The other lesson is that volatility is the hallmark of capital-intensive industries and commodities. They're normal. They're natural. They're to be expected, and they're to be either used or at least endured. If you, in precious metals, look at the history of precious metals markets, if you go back to the first market that I was involved in, which is the market 1970 to 1980, that was a market that made this bull market look like absolute child play. The gold price over 10 years went from $35 an ounce to a high of $850 an ounce. The silver price went from $1.50 to $50.
To understand today's precious metals environment, history offers a powerful reference. Between 1970 and 1980, gold surged from $35 to $850 per ounce, while silver climbed from roughly $1.50 to $50. Yet within that extraordinary decade, gold fell by 25% or more on 4 separate occasions. In 1975 alone, it dropped nearly 50 cents without ending the broader bull market. Volatility was not an anomaly, it was a defining feature. Investors who endured those swings were ultimately rewarded. The past reminds us that sharp corrections can coexist with long-term structural uptrends.
The lesson in that market that's applicable to what we just went through in the silver market is that 4 times in the decade of the 1970s, precious metals prices fell by 25% or more. And in the middle part of the decade of the 70s, the gold price in 1975 fell by half without derailing the bull market. It's important that people who are going to participate in precious metals markets understand that. It's important to understand that although I believe that we're in a decade-long market for precious metals, that in the next decade, the type of price action that we saw in late January, early February, will occur to us 3 or 4 times. You need to expect it. You need to be financially prepared. You need to be psychologically prepared. There are some people for whom that's unnerving, and those people should invest in other sectors because volatility is going to occur. I attracted a lot of notoriety, and by the way, a lot of hate, when I told people in January that I had sold about 80% of my physical silver. I didn't sell it because I knew that the price was going to collapse. In fact, I missed a bunch of the up move.
Commodity markets are capital-intensive and cyclical by nature. Mining projects require years of investment, and supply responses are slow. As a result, prices swing widely between scarcity and surplus. For precious metals investors, this means turbulence should be expected, not feared. In any multi-year bull cycle, dramatic pullbacks may occur several times. The real question is not whether volatility will appear, but whether participants are financially and psychologically prepared for it. Those unable to tolerate wide price swings may struggle in this sector because instability is not a flaw, it is part of the structure.
I sold it because, for me, physical silver occupied a speculative part of my portfolio. I save in gold, I speculated in silver. I bought silver when silver was hated, and I bought it because it was hated. I didn't buy it because it was hot, I bought it because it was not. Specifically at $20, I thought that when the hate around silver dissipated, that silver could go to 50. I was wrong, it went to 75. In fact, it went to 100. At 75, I sold 80% of my silver. Not because I anticipated a price decline, really, but because silver gave me everything I wanted as a speculation. Further, I believed that the silver stocks were long-term undervalued relative to silver. I thought if the silver price could stay at $75 or better for a year, by definition, if the silver traded sideways, my silver wouldn't make me any money. But the high-quality silver stocks were valued using a $40 or $45 price assumption for silver when silver was selling at 75, which meant that over the course of 12 months, the stocks could re-rate up by 50%, even with silver going nowhere.
Successful resource investors often move against the crowd. Buying silver at $20 when sentiment was negative required conviction. Selling portions of holdings near $75 required discipline. The decision was not about predicting collapse, but about achieving a predefined objective. When speculation becomes crowded and enthusiasm peaks, risk increases. Many investors enter only after prices surge, seeking validation from momentum. Yet the greatest opportunities typically emerge when narratives are ignored and assets are unpopular. Contrarian thinking, buying when others hesitate and trimming when excitement dominates, has long defined resource market success.
That's sort of the calculation that I made. My suspicion is that I was competing in a market with speculators whose methodology was got a hunch, bet a bunch. And those people always get wiped out when you have these precipitous share price declines. Many people, Danny, most people, I think, unfortunately, if they understand the narrative, they don't buy the narrative until the price performance in the underlying commodity justifies the narrative. Which is to say, there were no buyers in the silver market at 20, and there was a boatload of buyers at 60. The narrative was equally true at 20, but there was economic reward exercising the narrative at 20. But you had to be willing to understand the narrative without the psychological reinforcement of the price move that drove people in later. The successful speculator in natural resources, in any capital-intensive cyclical industry, the successful speculator is a contrarian, and the guy who gets murdered is a trend follower.
While silver itself captured headlines, many high-quality silver mining companies were valued using conservative assumptions, often pricing silver at $40, $45 per ounce, even when spot prices traded far higher. This disconnect creates potential opportunity. If silver prices remain elevated, earnings surprises can emerge as analysts revise models upward. Companies such as leading global producers and royalty firms may benefit disproportionately, particularly if operating costs remain controlled. In stable or sideways metal markets, equities can re-rate higher as valuation frameworks adjust to sustained pricing realities.
Which is precisely why I bought them. When I look at the earnings estimates from Wall Street and Bay Street around the silver miners, what I see is that the earnings estimates and the net present value calculations are done at an assumed price of $40 an ounce for silver. An earnings surprise occurs when the analysts are basing their cash flow assumptions on $45 silver and you're selling $75 silver. That's precisely why I own the Pan Americans of the world, the Wheaton Precious of the world, because irrespective of the performance of the indexes relative to the commodity, the assumptions that go into the valuation calculations around the individual silver miners are at a substantial discount to the silver price. And if the silver price doesn't fall further, not all the silver producers, but the high quality silver producers, the ones that won't deliver cost disappointment, can be expected over the 12-month time frame, if the silver price holds in, to substantially outperform the metal.
In natural resource markets, emotional decision-making can be costly. Speculators who buy purely on momentum often face steep losses when corrections arrive. Long-term participants, however, Focus on fundamentals, valuation, and risk management. The key is not predicting every swing, but positioning strategically. If silver prices stabilize at higher levels, well-managed producers may outperform the metal itself, but if prices retreat, disciplined investors adapt. The enduring lesson from decades of commodity cycles is clear. Success belongs not to the loudest optimists or pessimists, but to those who remain patient, contrarian, and prepared.